Right up front, this is going to be a mile wide and an inch deep. Almost every topic I'm going to raise here could in itself be at least a 1 hour lesson. And some of you will probably, some of these things go, well, duh, I knew that. Hopefully a lot of it, you'll go, oh, I hadn't thought about that, or you'll think about it from a new perspective. Hopefully you can jot down some ideas, because every topic I discuss, I love technology. There's a wealth of information out there. Just make sure you find good sources. And after we're done, I'm happy to have one-on-one conversations. I welcome questions. I just don't want Jason to run out of time. How many of you know Jason Morrell? Okay. If you don't get to know him, he's about the best guy you'll ever meet. But I will tell you this, he's a little bit strange. He likes economics. My worst grades in college were in microeconomics and macroeconomics. And I can't remember which was which, because I still don't know what's micro and what's macro. And he loves this stuff. Talk to him about economics and he can talk forever. So I thought I better start out with the difference between accountants and economists. Okay? Accountants fix the past. Economists ruin the future. Then why did the accountant cross the road? To reconcile the other side. I know these are bad, but they're intended to be. I'm an accountant. Why did the economist cross the road? It depends on a complex set of variables that we can't really measure. Is that accurate? Correct. One more. An accountant will tell you what you can't afford. An economist will tell you why you should feel good that you can't afford it. Okay? So, I'm going to dive into this. Anybody recognize this guy? Ruby? That's the accountant, number one. So, Ben Affleck, he's a lot more exciting accountant than I am. I want to just start out with a quote by this guy. Anybody recognize this guy? Warren Buffett. Depending on where you look, he's somewhere between number 4, number 7, the richest man in the world. And he has made a living off of his understanding of how to read financial statements and financial data. Well, more than a living. And he says accounting is the language of business. He views accounting as a necessary tool to track progress, make informed decisions, that's what he does in his investment world, and assess a company's health, and similar to the language for communication. So accounting is the language of business. It's not always the most exciting thing in the world, but hopefully from this presentation, if you take one thing away, it's the importance of doing it and doing it right. I went backwards. I better not use that clicker. I want to just start with a few stories. Some of these well, at least one of these may sound familiar to you, and I do have to use notes for these. Anybody heard of Enron? Enron, the company that faked its way to the top. Once upon a time, Enron was the biggest, most admired, one of the most biggest, most admired companies in America. They started out as an energy company, but they didn't just sell gas and electricity. They claimed to be revolutionizing the way energy was bought and sold. Wall Street loved them, and their stock soared. But behind the scenes, Enron was like a house of mirrors. Their leaders were playing a dangerous game of hiding the debt. They created shell companies that would report their debt so that they didn't have to, thus misstating their financial statements. But, as always, someone finally looked close enough and realized that their numbers didn't add up. And when they found out, investors lost trust, the stock crashed almost overnight. Thousands of employees lost their jobs and their retirement savings. The CEO and top executives got arrested, and even their accounting firm, Arthur Andersen, which was one of the 8 biggest accounting firms in the world, went under as well. Let's go a little bit smaller. I think I'm going to get rid of that mouse because I keep on. A local restaurant. Okay? Great food. There's a small locally owned restaurant in a college town that was always buzzing. Probably can think of one. The food was great, service was friendly, the place had a loyal following. You would think they were thriving, and in some ways they were. But behind the kitchen doors, the financial side of the business was a mess. The owners were passionate about food, but clueless about accounting. They tracked their expenses loosely, didn't separate their personal and business bank accounts, and they paid employees mostly in cash. To them, cash was easy and quick, and it saved on payroll taxes, right? Well, sooner or later, guess who finds out? The IRS caught wind of this, send out an auditor, and anybody got a love letter from the IRS? Sometimes they're 3 years late. And what do? Penalty and interest. And it adds up, and it adds up fast. This restaurant was hit with back taxes, penalties, and interest, a bill they couldn't afford, and their doors shut down forever. One more. Fashionable on the outside, a mess on the inside. A trendy boutique store. Very popular on Main Street in a small town. No, it's not Nephi. The owner had a great eye for fashion. The storefront looked amazing. The Instagram feed was full of happy customers posing in stylish outfits. Behind the scenes, it was chaos. The owner loved fashion but hated numbers. She didn't track inventory, didn't use any real bookkeeping system, had no idea how much money she was actually making or losing. She spent a lot on displays, decorations, and new arrivals without budgeting. After the holiday season, sales slowed down, the bills kept pouring in, she had a cash flow problem, and eventually had to shut her doors and couldn't catch up. Those are just a few examples of things that can be very symptomatic of poor accounting. I want to just touch through some key concepts for entrepreneurs. And again, mile wide, inch deep. We're not going to go very deep into these, but there's some things that I want you to get thinking about and that hopefully will help you, whether you're just starting out in a business or currently in a business, but things for you to consider. First, if you're going to start a business, make sure you come up with a good startup budget. What's a startup budget? Just forecast everything you can possibly think of that you're going to need to get your company going. Break out things in categories of fixed costs versus variable costs. Fixed costs are the things that you're going to have to pay regardless of if you sell or provide any services. They're going to be your rent, your insurance, things that you know you're going to have to pay. Variable costs are going to be the things that are going into your product, your raw materials or inventory, what have you. But those are going to make up your total cost. And then closely related to that, understand profit margin and do a break-even analysis. Hopefully those words mean something to you. If they don't, very easy to do research on them. But your profit margin, you need to know how much profit you're going to make for every single item you're going to sell or service you provide. Think of those fixed costs and variable costs and set your price on the profit margin that you need. And your break-even analysis, how much of your project do you need to sell before you start making a profit? Where is your break-even point? That's going to really help you in developing a startup budget and tweaking it. Okay? Separate your business bank account from your personal account. I hope this is a duh. But so many people won't do this. And everything will appear to be just fine until that IRS auditor shows up. And you won't always have an IRS auditor. The problem is you don't know, and it's never timely when you do. But make sure you keep your businesses separate from your personal. Learn the proper accounting for how to take withdrawals from your business or provide capital to your business. and properly account for that so that you can record that in your business properly, and then keep everything else separate as much as possible. Make sure you have a good bookkeeping system. And that's kind of the point of the cartoon there. It's pretty small, but Patrick, we have technology. Technology makes accounting systems a lot easier. There are a whole bunch of products out there, QuickBooks, Xero, Wave, even Excel spreadsheets. And if you're small, even though in this modern age, we have so much technology, it's still okay to do it by hand. And any of you have monetized? Anybody know Nyla Key? Here's the chuckles and the smiles. Nyla Key was the school secretary at Mona Elementary for decades. And when I started, I was amazed, and this is a long time ago, but we still had technology. I was amazed that she was doing everything by hand. And as a young, energetic CPA, I'm like, why are you doing this by hand? I wanted to force her to go to a computer. I never caught Nyla making a mistake. She reconciled everything to a penny, never went over budget. Her records were in perfect order, and I just said, if it ain't broke, don't fix it. And until the day she retired, she kept Mona Elementary's records on paper, and they were in perfect order. As soon as she got replaced, they wanted software. Okay, but yeah, have a system to track your income, your expenses, your assets, your liabilities. Hopefully those words mean something to you. Go into those. And definitely invoices and receivables. Sometimes it's really easy to ignore your receivables, and I probably don't need to stress the importance. You've got to make sure that money's coming in. You've got to have that cash flow. I think it's great now, like QuickBooks, other programs, they have ways that will automatically text their customers their bill and allow them to pay it online. Me personally, I have a company I do business with in town, and they always text me, and it always seems like the absolute worst time. And so, yeah, I just put my phone back in my pocket, or I'm driving or something, and then I forget. And that first notice is very timely, but I forget, and I generally pay my bills always on time, but it's really, really easy to forget that one because I missed that first text. So maybe a little bit better job on following up, but make sure that you're tracking those receivables and those invoices and following up on collections. Payroll, if you have employees. How many people have employees? Yeah, I can't overemphasize the importance of making sure that you stay in compliance with all the payroll laws. Make sure you have a good system to handle your taxes, your withholdings, and all of your compliance items. If you have contractors, don't forget to send out the 1099s. That can get you in a lot of trouble as well. That was one of the examples that got that restaurant in trouble. Continue on, tax compliance. Know your filing requirements. Understand your federal, your state. There are even some local requirements with licensing, maybe property taxes, but you do not want to have a close relationship with the IRS or the Utah State Tax Commission. Best if they're kept at arm's length. Also, something that gets a lot of people in trouble, track and set aside sales tax. If that extra cash comes in, it's really easy if you're not accounting for it properly to just include that as you pay your bills and do other things, and then lo and behold, you have to file your sales tax and you don't have the right cash flow, and that'll get you into trouble as well. And then sole proprietors, LLCs, you'll want to make sure that you understand what's going to be due and plan for your estimated income taxes and make quarterly tax payments if those apply. Understand financial statements, even at a just basic level, come to an understanding of a balance sheet, income statement, cash flow, and then perform these for your business on a regular basis. Balance sheets, and it can depend on your business, but I think once or twice a year, to me, is generally good on a balance sheet unless you have specific issues or other specific needs. Income statements I'd do at least on a monthly basis, very least a quarterly basis. And again, this could be very dependent on your business. And cash flow. Cash flow is going to tell you how your money's coming in and how it's going out. And really help you understand and be able to time and meet your obligations. And then you can never do enough budgeting and forecasting. A lot of times budgeting intimidates people. And I think the reason is people don't know where to start. And the reality is, when you do your first budget, I dare say you're going to be wrong. But so what? It's a starting point. If you're budgeting and you're tracking over time as you tweak it, you're going to get better and better and better. And you're going to be able to forecast your needs, and you're going to see that your business operations are going to benefit from it. Guaranteed. So make sure you do plenty of budgeting and forecasting. Internal controls. Anybody know what internal controls are? Hopefully everybody. But those are simple things that you, processes that you put in your business to prevent fraud, basically. Is anybody exempt from fraud? Maybe if you're a sole proprietor and you don't have any employees, you don't have to worry about this. But have you ever been to a restaurant? A lot of times I see them in the mall eateries. There'll be a sign that says, your meal is free if you don't get a receipt. Anybody else ever seen those? That's a simple internal control to the company's trying to make sure that $10 bill doesn't go in the employee's wallet and then he just gives you the food in his pocket. That's a simple internal control. But make sure that you have processes to protect your businesses, to protect your cash, and everything else. And then the one thing that I would like to see people do more of is so simple. Review your bank statements regularly. Now, if you're a sole proprietor and you're the only person there is, there's not a lot of risk there. If you turn your checkbook over to somebody else, make sure that every month when you get that bank statement, you're reviewing it. And I would go out of your way, even if everything is absolutely perfect, whoever's managing your money, I'd ask them a few questions from that bank statement. Because what that does is that tells them that somebody's watching, somebody's checking. But almost everything has to eventually run through that bank statement. It's so important, so critical.
Can I add something to that, Darin, too?
Yeah.
So just from a bank standpoint, there's not as many regulations and rules that help commercial customers, right? It's built towards the consumer. So if you're not reviewing your bank statement and you have fraud, not internal fraud, external fraud, your timeline window is way shorter on a commercial account than it is on a consumer account. So you won't get a chance to get your money back, right? So just make sure, I would echo that and times it by 1,000. Review your bank statements often, if not daily. So
what's generally the time frame, like 30 days or less?
Depends on what it is. Like wire, you're screwed. Right? You're just flat out done. It could have happened an hour ago and you're done. Right? ACH wise, depends if it's submitted. There's two different ways to submit. There's actually several different ways to submit, but the typical ones are CCDs and PPDs. If it's a CCD, you don't have any recourse, maybe a week. If it's a PPD, you got like 60 to 90 days. So it depends on how they submit and how they request that money. So, but like debit card transactions, that kind of stuff, your time limit is really limited. You usually have about a month typically, but just review them often. Like I would almost say, get online banking and look at your statements often. So even before you get the mailed one.
Yeah. So again, go ahead.
I just mentioned this to Riley too. It doesn't matter who your accountant is, you can trust them with everything. Still make certain you're checking on them because there's always temptation for them, and if you give them too much control, that gives them the opportunity to find loopholes.
Yeah. So I started my career with the state auditor's office and worked out of the state capitol. In fact, it was kind of fun. As a BYU grad, my very first day on the job, I audited the athletic department at the University of Utah. Oh, they gave me a hard time. They were so professional and so good. But I could, and maybe I should have, but I could give you a list of people that have gone to jail for cheating on very good, close friends and business associates. You never know what's going on in somebody's life, and they might have a crisis, and they might just need $100 that they're going to for sure pay back next week. Nobody's exempt. You have to hope for the best and assume the worst and just protect yourself, okay? Because that happens. It's unfortunate, but it does happen. So I've covered a lot of topics, and I would love to answer questions. Are there anything that sticks out? Told you accounting was exciting. Okay, I'm going to tag team off to Jason, and then we'll be available for
You're done already?
questions. Yeah,
And we can maybe do a joint question session after if you think of something.
absolutely. And that's one of the things I was going to point to. The accounting oftentimes leads you to the banker. The banker is going to want to see your accounting oftentimes. And so they are very, very closely related.
Yeah, that's why this presentation is put together, right? Because a little bit of the accounting stuff, which leads us to you're gonna need some money, right? Every business just needs money. So we're gonna talk a little bit about that. Yes, I am an econ. I did graduate in economics. And micro is small scale, macro is big scale, in case you were wondering.
I know that.
So the macro stuff tends to be more how the government handles things. Micro is how the individual business handles it. But that's in case you're just interested. I do have to say though, if I was going to do some financial accounting type stuff, yes, there's a lot of good software, but a video game to me is Excel. I know that seems really weird, but Darin probably feels the same way. But we get some problem or whatever, we try to solve it with Excel. I'd rather type an essay in Excel than in Word, because I love Excel that much. So I get giddy when my daughter comes home with some assignment that she's got in her class and she can't figure it out, and I've got to figure it out for her, and I just, I'm midnight working on it because I'm so excited about it. So, I'm weird that way, and I'm sorry. But so I'm a banker. I've been a banker. I've been in lending. I've been banking for 25 years. I've been lending for about 20 of them. And so I've worked for 3 different banks in the same chair. For those of you who grew up in Nephi, you know exactly why. It started off as a Far West Bank, and then American West Bank, and now Cache Valley Bank, and it's the same chair. But all of them, ironically, handle the loans, the lending stuff, very similarly. I've gone to conferences, talked to other bankers. Everything is really similar from one bank to the next, or credit union, financial institution, whatever you're looking at here. So one thing that most financial institutions look at is their cash flow. Cash flow can be positive or negative, and there's reasons why during the cycle of what's going on as far as if that's good or bad. You can have negative cash flow, which is the reason why you need a loan, right? Or you are foreseeing possible negative cash flow, which is another reason you might need a loan. Or you want to prevent yourself from getting negative cash flow, which is why you need a loan. We'll get into some of those examples. So, whoops, I'm getting a little fast there. So we got positive cash flow indicates that there's more money coming in than going out, right? That seems pretty obvious. Companies' liquid assets are increasing. This enables it to settle debts, reinvest its business, return money to shareholders, pay expenses, and provide a buffer against any future financial challenges. Negative cash flow is the exact opposite, where liquid assets are decreasing. Liquid asset, just for a little thing, liquid assets tend to be your short-term stuff like accounts receivable, inventory, cash even can be considered a liquid asset, right? So those are typically your main ones that you'll have in a business. And then your liquid, like your other, on the other side of that would be like credit card payments, short-term loan payments, accounts payable, so if you gotta buy supplies from people, right, that's where that's gonna come into play. So, you just gotta make sure that you're bringing in more than what you're sending out. Now, again, there's a little bit of a give and take there. For example, let me give you one. It's pretty obvious for a lot of people within a small town. Look at a farmer. Right, right now, a farmer just planted his grain or corn, right? He's watered it. He's put fertilizer on it. He's put a whole bunch of diesel into a tractor that planted everything. And so he has just put out a whole bunch of money, right? What does he actually have now? Nothing. He's got negative cash flow, right? He has nothing. There is no current asset. There's no inventory. It's barely coming out of the ground right now. He can't go cut it, right? There is nothing there for him. Every day, though, that gap starts to shrink because that corn's a little bit taller. Every day. Every day it's a little bit taller. And so then you get towards the end of the year, and now it's the exact opposite, where now they've got a crop. That crop is worth more than all the inputs he put into it at the beginning of the year. Right? So that's not necessarily a bad thing when I say the negative cash flow can be. It does happen in a business cycle. So that's just an example of what one would look like. And then a quick test of how to determine if you have good cash flow or not is to actually look and see what your current assets are divided by your current liabilities. If you are above 1, you have positive cash flow. Pretty simple that way, right? Your current ratio, the quick ratio is one of the best quick tests. That's why they call it quick ratio. It's just a quick test to see if you have positive cash flow. So that's one thing you want to keep in mind there. You got that little thing you can read there. And then this is one of the key metrics that we use in banking. And this is usually the reason why you need financing, is because this will tell you how you're doing. Oh, and I forgot that last one here. One of the other key metrics that we're going to look at, and it was at the bottom of that last slide, is EBITDA. It's an acronym, and it's earnings before interest, taxes, depreciation, and amortization. It's a mouthful.
Can you go back that slide?
Yes, I will go back here.
Thanks.
It's covered by your meme.
Right down at the bottom.
There you go.
Down the bottom,
I'm
right?
not gonna remember that in my brain.
Earnings before interest, taxes, depreciation, and amortization. That's probably the number one ratio, or number one calculation we're going to look at as a financial institution. So I take your net income, whatever you put at the bottom of your income statement, I take your net income, I'm going to go back and add back your interest expense, and I'm going to add back your depreciation, I'm going to add back the taxes you paid, and I'm going to add back the any amortization. Amortization usually is like blue sky type stuff, which most businesses don't have, especially small businesses. That's going to give me a bigger number. So you could have a negative net income of $100,000, but you might have $300,000 in depreciation because you reinvested everything you had back into your business and bought the equipment, bought whatever else. And so I'm going to add that back because that was a one-time deal, right? That's not an ongoing thing. So I'm going to add that back. And then I'm going to take that $200,000 now, and I'm going to divide it by your debt payments. So if I can get a positive ratio, a debt coverage ratio, that's above usually 1.2, which means you can cover all of your debts 125% of the actual payment. Now I'm starting to get a little bit in the weeds. Some of the accounting people kind of understand what I'm saying there, but that is one of the key measures you want to do. So that if you know you got good positive cash flow there, I've had several companies come in, they've lost $500,000 in a year. Because they've got a lot of depreciation, they've got a lot of interest expense, they paid a lot of taxes, and I do a loan. I don't have a problem with it. They make their loan payments just fine. So just because you have a negative thing doesn't, there's a lot to tell in a tax return in the income statement. So All right, so you decided that you need some money, right? So let's go talk to a loan officer, and this is about how it goes. All right, pretty close.
Where do you live?
The city.
Do you have a house?
Apartment.
Own or rent?
Rent.
What do you do for a living?
Lots of things.
Where's your office?
I don't have one.
How come?
I don't need one.
Where's your wife?
Don't have one.
How come?
It's a long story.
Do you have kids?
No, I don't.
How come?
It's an even longer story.
Are you my dad's brother?
What's your record for consecutive questions asked?
38.
I'm your dad's brother.
You have much more hair on your nose than my dad.
How nice of you to notice.
I'm a kid, that's my job.
Right? John Candy, one of the greatest comedians out there. You know, I wish he was still around, but that's kind of what it's going to be like when you go to talk to, you know, a loan officer for the most part. You're going to get drilled with a whole lot of questions, right? We got to know the story. We got to know why. We got to know what you know, because you know a whole lot more than what we know. So I got to get to know your business as well as I can before I can do anything.
Where do you live?
Oops, just pass that one. So what are your lending options? A couple things that we want to kind of look at here are, is it short term, which is typically 3 months to a year? Can be shorter, right? On those ones, those are typically like a working capital type situation where you got to put out a whole bunch of inventory initially, or you got to buy something to make something, right? Like you got to buy, let's say you're a steel fabricator. You got to buy a whole bunch of metal before you can make anything. And so you're going to need that short-term stuff so that you can make it and you can get it to market, right? So that's one of those things that you just kind of need to finance some stuff. Sometimes people have startup costs where they're really dead in the winter, and then all of a sudden in the spring, things pick up because of the seasonality of the business. And then all of a sudden you had to put out a whole bunch of stuff like a farmer, right? And you don't really have any inventory yet, and you haven't been able to sell anything. So those are typically a little bit more on the short-term end of things. You can have intermediate type lending options, which are going to be like 2 to 7 years. There's different loan products for each of these different things. And so an intermediate stuff is going to be like if you need to purchase some equipment, buy a truck, you know, if you're buy a mini excavator, whatever it is your business looks like. And then those are typically the intermediate ones, just shorter term deals. The last thing that you want to do is finance through your business a long-term asset, because you need that cash flow. So you want to get a loan on stuff so that you can maintain your cash flow. Does that make sense? Unless your cash flow is really, really good, really, really strong, and you can afford to absorb paying something like that without it hurting your ability to make your payroll in a month, then you're probably okay. But if you get a loan on it, you can pay it back fast, but if you get a loan on it, you're better, you can maintain your cash flow. So to get against seasonality type stuff. I know that kind of seems weird because you're gonna have interest expense, the money's not in the account earning interest, all that kind of stuff, but usually that will kill a business faster than anything is if you don't have enough cash to make your payments. So, the next one is a long-term debt. For sure you do not want to use your cash flow to do something with long-term. If you do, you might as well not be in business. If you have a long-term asset that you are purchasing, you need to get a loan on it. You want to pay it off early, that's fine, right? But you need to get a loan on it. And these types of deals are going to be like real estate, large specialized equipment, and those kind of things. So we've got, those are the main things that you're going to want to do, right? Make sure that you finance a long-term asset. Very few companies can absorb buying a long-term asset without getting a loan. So what are our options within these things? So on a short-term loan, what are some of the options you've got? You've got an SBA Express loan. You've heard of the SBA, everyone's heard of SBA. I get a lot of people come into my office wanting to get an SBA loan because they read something online. An SBA Express loan has different terms. So typically it's a 7-year loan or a 10-year loan. But within that 7 or 10 years, it is a revolving credit feature that lasts for a year up to 5 years. And then whatever the balance is at the end of that year, or whatever that balance is at the end of the 5 years, it gets turned into an amortized loan payment. Right? So that one is that's a good loan option. It tends to be for riskier type businesses. The SBA is going to guarantee my loan at 50%. So if you default, remember here, the other thing you got to keep in mind, most loan officers are pessimists. Right? Just go in there knowing that we are pessimists. We are going to assume that you are going to fail. That's how we look at every loan. You're going to fail. We hope the heck you don't. But that's how we're going to look at it. And so that one's a really good product. If you got something that's a little more long term, I do have to say though, it is involving the government. It's a pain in the butt. Just being honest. It takes some time. If you need some money really quick, within like 3 or 4 days, this is not your option.
They call it express.
They call it express, but it's more like 2 weeks. And then depending on what type of collateral you've got, it could be a month. Right? So the SBA also wants to make sure that they take anything available because they're assuming you're going to default. So if you don't have a second mortgage on your house, we want to take a second mortgage on your house. If we look at your inventory, we're only going to give you about 10% of the value of all your inventory. Because what good does a whole bunch of, I don't know, yarn do me, right? I can't sell yarn at full market value when we're in a foreclosed situation, right? I might get 10 cents on the dollar. So we're going to look at your inventory at 10% of what it is, right? Your accounts receivable at 50%. So usually you got to throw in a whole bunch of stuff. You got a vehicle that's free and clear. You got four-wheelers that got titles on them or side-by-sides. The SBA is going to want to take everything that they can get their hands on up to being fully secured. Now, if you don't have it, you don't have it. Chances of getting a loan go down a little bit. There are some more aggressive lenders out there that will kind of do those types of things, but I've seen them do it, and it's a very high failure rate. That's one option you have for short-term type lending opportunities. The other thing is just to get a conventional line of credit. This would be just going to the bank. We have enough collateral. I can look at it a little bit differently on this one because I'm going to review your loan a lot more often. Right? On that SBA Express loan, I'm only going to review your loan kind of every year, but I'm really not going to pay attention to it because I'm assuming that everything's going okay as long as you make your payment. Right? On a conventional loan, I'm going to look at that thing every year. I'm going to get your taxes. I'm going to go through your whole business statement. I'm going to go everything. I'm going to dive into your credit, look at your net worth, the whole thing, as far as that one goes. Both of these are variable rate. Short-term lending tend to be a little more variable rate. So the rate's going to go, it's typically tied to the prime rate, plus a spread. So if we're looking at, usually it's 2 on SBA Express loans, it can be 3, the spread. So you're looking at prime right now is 7.5. So, plus 2, you're 9.5 right now. When it was about 4 years ago, who cared what prime was? Because it was so low that it didn't really matter. But that's kind of what you're looking at there. Be careful a little bit with these ones though, because there can be teaser rates for the first 6 months. You're going to get it for 5%, and then it's going to jack you up to 12 and 14% afterwards. Just be a little careful with those ones. You'll see a lot, especially the online ones that you can get from Quicken or from lending.com, LendingTree, whatever all the other ones are out there. They sometimes have really good teaser rates. Just make sure you know what the rate is after the teaser rate, just in case things slow down. You don't know what you're going to be hit with on your business cycle. So just kind of keep that one. And the last one option is kind of if it's a small one, it's a credit card. A business credit card. You should probably have one anyway. In all honesty, you should probably just have one anyway. A little harder to buy some stuff, but it's hard to make your payroll with a credit card. But you buy a whole bunch of inventory or something like that, and then you use the cash that you do have to make your payroll, right? So it's just juggling around a little bit. That's another option. If it's short term, usually you don't want to get a loan for anything under anything under $5,000, you're better off just getting a credit card. In fact, I'd almost say 10,000. If you want to get anything over 10, then maybe look at a loan. Anything under 10, you're probably better off with a credit card. So, because the fees and everything else like that to get everything going are just going to be pretty high. So that's your short-term stuff. On your intermediate, do you want me to go back on that?
It's okay.
Okay.
Thank you.
On your intermediate loans, there's an SBA 7A loan that's out there. This one is government guaranteed up to 75%, depending on the loan amount. So that's why I'm a little bit more eager to do these kinds. Again, the paperwork is not fast, it's somewhat quasi-government. It takes some time. There are some fixed rate options that can go maybe about 5 years, 3 to 5 years. It's fixed rate, whatever the rate is, and then it might adjust after that. Typically, usually it's paid off within that 5 years. Collateral sales, it's very similar to the situation with this Express. If you've got it, they want it. So that's just kind of how we look at it. If you've got something available, then they're going to want to have it. So, but usually you're going to, those are the kind of intermediate ones, so some equipment, that makes a lot more sense right there to do that. Like getting a car loan. So if you're going to buy a truck for your business, dump truck, whatever it is, this is kind of, you don't really want to use a 7A, we want to do a conventional route on that one. Because that one's easy to liquidate. So I wouldn't recommend that one. So the other one is the conventional route. Anything that's very common, you're going to want to take the conventional route, like a truck. Certain specialized equipment, you might want to do the 7A loan, like if it's a printing press. It's not something I can easily sell. And so that's going to be a little harder to do. But if it's like what would be a very common machine, like a mini excavator or something like that, that's something I can get rid of fairly quickly. And it's still in high demand. So those types of things, you probably want to go on the conventional route of it. So again, very similar as far as the terms go, length of term, the rate. These ones typically bear a little less on the paperwork than an SBA one. Now, long-term wise, SBA 504. This one's a fun loan. Okay, this one's a fun loan. This one's a very intriguing loan. So the reason why they call it a 504 loan is because 50% of it is the bank, 40% is the SBA, and it requires 10% down. Very little down to buy a business, to buy a real estate. It can only be used for real estate. And so this one's a very intriguing loan. This actually is a pretty good loan. Like I would recommend this loan to a lot of people. Just because it doesn't require you to have that much money down. If you're going to buy $1 million property, you only have to have $100,000 down. Versus a conventional route, you got to have a whole lot more than that down. So this 504 was good. The only drawback to the 504 loan is on that 40% portion, there's an early penalty if you pay it off early. So that's the only kicker about that one. Because what they do is they go out and get a whole bunch of funding from somebody else who wants a good return on their money. You pay it off early, they don't get that return. So that one is a really good loan. If it's a specialized type property or real estate thing like a car wash, the car wash can only be a car wash. Right? That's about it. And so that's specialized, they're going to require a little bit more money down. If you're a fairly recent startup, like within a year, they're going to require another 5% down on top of that, so now you're at 20% down. So, like these tunnel washes, right? They make good money. They make really good money. It's a big fad right now. 10 years it might not be, but right now they make really good money. But you're going to have a lot more money down because you're going to start up on a car wash. So, and the other kicker too is you have to occupy 51% of the building. You can lease out the other 49%. You just can't lease out 51%. So if y'all want to build a strip mall, well, I'm only going to take 30% of it. I'm going to rent out the other 2 units. You can't do 504. So
What if you changed in the middle? What if you were renting out 66% and then changed after the loan was closed?
You have to do it before the loan closes, you have your 151. If you change afterwards, just make sure you don't get caught.
Just don't answer the phone when they
That's really what it comes down to. Really what you're saying when you do the 504 loan, if you're doing 51%, you're basically going to tell them that by about 5 to 8 years, I'm going to occupy the whole thing. That's what you're kind of telling the SBA. I've never seen it happen once. Not once. In every 504 loan I've done, they've maintained their portion, they rent out the other one because the other side is just easy money. All right? It's easy money. So that's one that keep in mind. They can go up to 25 years on the term. The process, though, if you're going to sign a contract on one, a real estate purchase contract, and we do have an agent in this room, so I'll make sure she's listening when I say this. We need some time for this loan. It takes some time. 3 months, probably minimum, to get this loan done. It takes a lot of time to get this one done. So when you write that purchase contract, don't put it in a month. We can't get it done in a month. Commercial property is a lot harder than a house. So the other one is just to do it conventionally. This would be basically the same thing as that 50% that is the bank. Everything's going to be required there on the thing. We can go up to 25 years. It is typically they're variable. Every 5-year rate adjustment. It's tied not to prime. It's usually tied to the Federal Home Loan Bank out of Des Moines or Boston or one of those banks, right? Whatever their current rate is, plus a spread. Usually it's 3.5% on top of whatever their current rate is. Right now, this rate would put you at about 7.5%, which isn't that far off of a mortgage right now. So commercial stuff is very similar right now. Usually there's a pretty good gap, but it's actually pretty close right now. So that is kind of your lending options there. Required paperwork. It's going to be required pretty much for all of these loans. The last 2 years back business taxes, or if you have whatever you have available, you haven't been in business for 2 years, whatever's available. Your last 2 years from your personal taxes for anybody that's more than 20% owner, year-to-date profit loss, and a balance sheet. That's your income statement that Darin was talking about earlier. Depending on what your loan is, we might also want an accounts receivable aging and accounts payable aging as well. We're going to know what your collateral is, and we're also going to want to know how you stand personally, what your personal financial situation looks like. So if you have a house, how much is your house worth? How much do you owe? How many cars do you have? What are they? How much do you owe? What's your credit cards look like? How much do you owe? Any other debts you've got out there or assets? I got all this kind of equipment. What do you owe on it? Nothing. Great. I don't care. I just need to know what those payments are. So that's what that personal financial statement is going to tell you. And I promise you, lenders are going to ask for something else. Once they see that, and yes, we need the full return. Some people just send the first page. The first page just tells me a little bit of the story. So I need the whole return. There's a lot of stuff that your accountant put in that return that you guys probably don't know or understand, but I need it. So I can make sense of a lot of that kind of stuff. Yeah, it might be that thick at times, especially for big businesses, more complicated structures. It is big, but it's going to go in there. There's going to be statements going to tell me there's an amortization or depreciation over here, or that they took a withdrawal, or you switched for your accounting method from accrual to cash. All these different things that's going to tell me in that, and I need to know that. So, any questions?
How much does credit score factor in? You still, are the credit, is that system working for you guys still, or is it broken?
No, credit score is interesting because they're always altering the scale on that one as far as what they use. So you can be late on a medical payment, it doesn't affect you as much as it used to 10 or 15 years ago. House foreclosures, they changed that after the Great Recession. It doesn't affect you as much as it used to affect you. Certain things don't stay in your credit as long as they used to. They've really softened up the credit scoring process. One of the biggest things too is that, well, I looked it up on, right, if you went to Experian, you're probably good, but I looked it up on my credit card statement, and my credit card company says I have an 890 credit score. not the score we use, right? 890 out of 1,000 is what their score is, so really yours is about 720. So whatever you get, unless you're going directly to Experian, Equifax, or TransUnion and getting that credit report, that one, they usually won't give you a score. I'll tell you what your credit is if you do the free version. But credit score does kind of matter. Depends on what's on there though, because there's always a story. If there's medical stuff on there and your score's a little lower because of it, but you're on a payment plan, you've been making your payment, there's a story, right? I just explained. It's okay, right? Something happened, you got in a car wreck. You had to get Siegfried and Jensen and have them sue the company because they didn't pay out, right? There's a story. And so as long as I know that story. Now, if you're late, and it's periodic lates all the time, yeah. You know what I mean? Let's maybe work on that a little bit, right? That doesn't give me a lot. If I've got to chase a payment every month, I got enough to do besides worrying about chasing the payment. So but that is a good question. So they're not a hard, fast rule. If there was one, it'd be 640 and higher. But I've done most of people with 480 credit scores.
Can you give us another example in addition to farming when a negative cash flow is a good thing?
Developer.
A developer. Developer has all this outlay.
Yeah.
Construction is big on these ones, right? Just even a spec home, or if you're a spec builder, you have all this upfront cost. Especially, you could just buy the ground, but you've got to do all the engineering, you've got to do all the soil testing, you've got to do all the architecture, you've got to do all this stuff, and nobody even knows that you did anything. And you just spent $300,000, $400,000, and nobody knows anything. If you decide you're going to turn around and sell it, you might not sell that information with it, and you're out. So, right? Is that what you meant as far as the developer?
Yeah. Or you're out because they didn't get it titled, right? Never got permitted.
So that's another example. Construction usually tends to fall in that category a little bit with negative cash flow. You take just because of the seasonality of it, right? In the winter, they're really cash rich in November because things started slowing down. They're not putting out as much. So all of a sudden they've got a whole bunch of cash because all the receivables that are 60 days late that they did all this work in August and September is now hitting their books in November. And so now they're just like, oh, I got all kinds of money. I better go buy a truck. I better go buy something else, right? And they don't use their cash to do it. They go and finance it, and now they've screwed themselves up because they got to pay them forever. And they go on these big vacations and live lavishly. And then they're screwed come February when they have to start putting all this money out and they don't have it anymore. Right, so just be super careful with that. So that would be another option. Seasonality can do quite a bit. Large projects, sometimes we'll do that, like a steel manufacturer or a fabricator. You gotta put out so much money up front to get it back. So that's where lending helps. Any other questions?
So Darin, if somebody's already in trouble with the IRS, what do they do? I know there's 3 or 4 in here, I can see. I saw you looking down during his presentation.
That is it depends. So I've had success sometimes just writing a letter and explaining the situation honestly and asking for forgiveness. I've been successful on behalf of other people for that. Sometimes,
Good thing you clarified that.
For other people.
yeah.
I have a friend.
I have in my business, for the school district, had some IRS issues, and we've always been successful. I haven't had any personal problems with the IRS. But we've all heard the advertisements. You can hire attorneys. There are some very successful attorneys. The most successful ones already have relationships with people and have more of an ability to negotiate. And so it really is an it depends answer, but I would always start with a letter, be persistent on the telephone. A lot of times these IRS people are like a lot of people, they have their kingdom and they're going to reign over it. And if you get on the phone with them and you lose your patience with them, you're probably not going to win. So it always pays to be professional and courteous, but yet forceful and clear. But if anybody's been on the phone with the IRS, I mean, plan on a couple of hours. Have a video game or something to have everything prepared so you don't, when the time comes, you're ready to go, but have something to do over here because you're going to be on the phone for a while. But I have had good success with writing letters. And but there are attorneys that specialize in that as well.
One thing I'd add to that is a seasoned CPA as well. As much as attorneys
Yes.
can help, a seasoned CPA that's been through audits
Mm-hmm.
usually is a valuable asset to help you.
And
They've
that,
navigated it before, they know the game, they know how to handle it.
yeah, thanks for pointing that out, Riley. There really is a lot to that. People that have, like myself, I don't know. I went through 6 audits last year for the school district. One was a 6-month legislative audit, no findings. But it's just such ordinary, everyday stuff for me. And you get a CPA that's a tax accountant, they've done these IRS audits a million times and they can walk you through. It really comes back to it depends. Is it a tiny issue? Is it a large issue? Same thing with your accounting program. You got a tiny business, you're just starting out, and then you grow. You're going to want to grow your level of expertise and your investment in specialists as well. Has that been your case, Riley? I know you just hired a pretty awesome CFO. So, hope that helps. Other questions?
Another one, Darin, you mentioned internal controls for fraud. What about internal controls for visibility? What would you recommend for some small businesses that it's a fine line? They don't have the benefit of a quarter review or a monthly review or an annual review because it's too late. What internal controls would you recommend to small businesses to kind of keep the pulse on things for their cash flow, for their profitability, their AR issues, those type of things? Any recommendations that way?
Well, dealing with such a wide range of business, it is going to be dependent again on your business, and it's kind of like I was saying on your financial statements. So for some people, you're going to want to be on top of that weekly. Sometimes a monthly is okay, quarterly, but it really is such a wide range. Whatever it takes so that you feel like you totally understand your cash flows, what's coming in, what's going out, and your aging of your accounts payable and your accounts receivable. I don't know if that's even answering your question, but it makes me ramble on to other things. For example, you're losing money if you're not collecting your accounts receivable quick enough. You're losing interest, you're losing something. If you're not paying your bills on time, probably all experienced a late fee here and there. You're losing money, you're throwing money away. Staying on top of things, whatever that means for your business, it pays off in the long run.
I think, just to add to that, I think if you, especially depending on the type of business though, your cost of goods sold is going to tell you a lot. Right, it's going to tell you a lot. If you're still selling gas, if you're a gas station, you're still selling gas at what you purchased it for at $2.50, and all of a sudden we have some terrorist attack and gas is now $5, but you're still selling it at $2.50. Your replacement cost on that cost of goods sold is way high. You don't have the money anymore. You're done. So you've got to monitor your cost of goods sold. Depending on, I think Darin's totally right, depending on the type of business you have. Right? Especially now with who knows, just being honest, who knows what tariffs. Right? If you're purchasing stuff from a foreign country, you don't know what that looks like. So I would be sure you're monitoring what your cost of goods sold.
Yeah, pay attention to that simple formula, fixed cost plus variable costs. I mean, think about all of the restaurants in town, what happened with the eggs last year. And if you're not paying attention, your cost of goods sold just went sky high with just the price of eggs. And so how do you answer that question? You just have to stay on top of everything. And it's like I started accounting. doesn't really excite very many people, but hopefully you can see how important it is. If you need financing, if you want to save those few dollars, if you want to be in tune with your cost of goods sold, if you want to be in tune with your profit margin and know what that should be, you just have to stay on top of it.
Just as a side note with eggs, I told my kids they could not have eggs for breakfast anymore. We have to save the eggs for cookies and brownies.
Brownies for you.
And now Jason has 5 chickens in his
Anything else? We love this stuff. That's why we have to do it for a living, right? So I know it can be pretty, I'm sorry if it was a little boring or something like that, but it is probably one of the most essential, vital parts of your business, is understanding your financial statements, your cash flows. So what your options look like. You can be the best marketer, you can be the best salesman. If you don't have cash, you're done. Just pretty much how it goes. So.
If you come up with questions later on and they're not too personal, you can post them. If it's a general question, put on our pages, and these guys will circle back and answer them. If it's a personal question, you can ask me, and we'll see if we can get you answers as you go along. But let's give these guys a round of applause.